Hi, welcome to Accounting Play. It's John at accountingplay.com. Email me, go to the site, subscribe, get some free stuff. Today we're talking about partnerships. Flow-throughs in general, partnership being a flow-through. A flow-through structure versus a corporate tax structure. General partnership. Limited liability partnership. Limited liability company, not corporation, company, and the SMLLC, which is sole member LLC for all you single LLCs out there. So this is a really, really exciting lesson for anyone who's ever been in business, wants to be in business. Huge disclaimer from my heart is that all this stuff varies hugely depending on your independent tax situation, what you're trying to achieve. So only, the really best thing you can do, number one, educate yourself, use your Accounting Play resources, learn, and then go find yourself a good attorney and a good accountant, stick them in the same room, and make some decisions together, given your individual tax situation as well as your business goals. But know about it first, so you're not burning up the clock asking them what a flow-through entity is. These just need to be like common terms for you. So let's talk about the old partnership. Partnerships, by definition, are two or more people, entities, etc., operating together. So, hey bro, let's start a business. Yeah brah, and something is formed. Not even necessarily have a contract. So, starting the partnership, two people. Now, multiple people can be, but we'll just say partnership 50-50. Partnership taxation is incredibly complicated, and a lot of this business structure has to do with taxation, also what you're trying to accomplish with the business. So this is a very informal business structure, which in some ways is an advantage, but in a lot of ways it's a huge disadvantage. So once you just start operating, that's how it goes. Huge disadvantage is unlimited liability, right? Issues of continuity of ownership at the end. Low cost, but really, if your partner messes something up and you're held personally liable, that is a horrific situation. So that's not something that's an honest and viable business operation. However, I've seen it personally as a CPA as maybe two members informally operating some property and other various holdings. So it's still a very relevant structure. And this 50-50, just to give you an idea, let's say there's a revenue of 100, well, I'd call it $1 million revenue, you have expenses at 300, 700,000. If this is just a partnership 50-50, how that would split down the middle would simply be 350 and 350. Now, on a tax return, USA, this would be delivered via a K-1. So, what's happening here? A separate return is being filed, so you do have a separate return, which is reporting this stuff, and the result is coming to the shareholder on a K-1. This act of coming from the partnership to the shareholder, think of this as water. It is flow through. Okay? Flow through. So, on a flow-through entity, the profit or loss will go to, in the case of individual shareholders, individuals, Now, in the case of businesses, if a larger business, different business structure owns a partnership structure, those K1s will flow in. So something even that I've seen that would be pretty abstract is a private foundation, right? Charitable intentions, let's say, giving money away, and they are also partners in investment partnerships. And so a charity can get a K1, a trust can get a K1, a trust can actually push out a K1. So we're going to talk a little bit about flow through entities in general. And so all this flow through stuff and good old Merca has to do from activity via partnership. So the partnership, a general partnership has all these disadvantages like the liability issues, continuity of ownership issues. But we're talking about partnerships in general now because I want to explain a little bit more technical nature of the entity that I don't get to go into in the app accounting flashcards or the Android version or even on the site in my writing, but I feel like my tax background is really relevant. So if you get a K1, you might know a little bit more about it. Certainly won't be an expert, but know how to ask some intelligent questions. So these flow-through entities can be a partnership, regular, and it can also be a limited liability partnership, okay? This would probably be, by law, some sort of accounting or professional services firm, right? So we won't really talk too much about this, but we will like to talk about the LLC, okay? The LLC is a limited liability company, not corporation, please. Limited liability company. LLCs, under the partnership law, have the ability to have a lot of different owners, as those partnerships, a lot of great advantages there, and have these flow-through properties. Now, on these structures, on this K1, you can have different allocations. One for profit, one for loss, and one for capital. And these actually appear on a K1. I refer to the K1 in the tax structure because that is going to be, the annual compliance filing, the tax associated, and this profit, loss, and capital that's appearing on the form K1 is memorializing what has happened on the partnership level as it now relates to the individual partner and flows into the tax return. Now, an LLC, you could have thousands and thousands and thousands of partners, like a large oil investment partnership, something like that. Now, another LLC might be 10 people, a small software development company, something like that. And so within this fun house of things, people can have different profit allocations, loss allocations, and capital. Generally speaking, you see that these things are all equal. However, capital is essentially ownership, so you can have more of a passive investor that's not assigned a profit or a loss portion, and these theoretically can be different, although I have rarely seen that. And so on this K1, as I was explaining, it's going to flow through the activity to the partnership level. And that activity might be ordinary income in one income category, it might be interest, it might be dividends, it might be capital gains, it might be a specific kind of loss called 179 deduction taken from the business. It's going to have lots and lots of different income classifications, which makes things all a bit more complicated. And this ordinary income, depending if it's an individual shareholder, may be subject to self-employment tax, or it may not, right? Now, if there's a loss, it may or may not be deductible in the current tax year. So there's a lot of different, maybe yes, maybe no. Partners are not receiving wages and W-2s. They're receiving guaranteed payments. Okay, so this is how people can have a partnership, and maybe someone working on the front ground on the onset or otherwise can be guaranteed a certain amount of payments every month. These would be guaranteed payments. Otherwise, it's going to be divided on those lines one way or the other of profit, loss, and capital. So this is a little overarching introduction on the tax side and this concept of flow through. No double taxation with the partnership at all. After, we are going to cover the corporation and how that differs from the partnership.